right. Good morning. 8:02 in the AM on Wall Street. 8:02 on Wall Street. Getting ready, what, for PPI? Who cares? But I'm glad you're here because we have a lot to talk about technically, and I suppose fundamentally, and maybe psychologically, whatever. You're the boss. I am just a humble currency trader, and I'm here to serve you. We gather here today to conduct technical and fundamental analysis with the overriding goal of removing risk. Why would we do that? Because trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results, but please always stay small, stay humble, focus on the long term. Never risk money you cannot afford to lose. My name is Wayne. I am here to bring you hope. Even a retired supermodel can find a second career in Forex. Yes. And if I can make that transition, so can you. Cool. So let me know how it can help. Like I said, I'd like to take a look at things like global growth. Hey, I'm a macroeconomist. I like global growth. So I think we can talk about that today, and we'll get some news, and then, yeah, good enough, right? So ask questions, get involved, take notes. In the description below the video, there are links that are super important. There's a link to my book, Strategic and Tactical Forex Trading. It'd be great if you left a review. Most of you have read it, I'm sure. If you could leave a review, that'd be great. Good morning, Pumpy. Slim Shady. Chicka, Slim Shady. There's a link to FX Bootcamp. At FX Bootcamp, we have a live trading group and a day trading group, and we're all meeting together today. Today is going to be the day. Yeah, we're going to meet today, all the day trading group members and all the swing trading group members, and we're going to plan out next week. Do some group work. It's going to be wonderful. It's my favorite day of the week. So, hey, if you want to sharpen your saw as a trader, or you need a group, or you need to learn how to trade Forex, FX Bootcamp is for you. Yeah, cool. There's Quant Box. Huh? Would you like to have AI sit on the Google Cloud and pull macroeconomic data from private and governmental institutional databases, pull it all together, arrange it, do comparative analysis, and display the data in beautiful, easy to read formatting, aka a quant in a box? Try it, man. The trial is $8. That link is in the description below. And then there's a link to Trader's Way, an ethical foreign exchange brokerage firm that would like an opportunity to earn your loyalty and respect. I recommend them. I want you to go over to tradersway.com and open up a demo. In fact, if you become a member of FX Bootcamp, one of the things you get for free, sort of a free bonus, if you will, is hundreds and hundreds and hundreds of files that get installed onto your MT4 or MT5. There's an auto installer that you download from FX Bootcamp, and it installs all these hundreds of files for you. So you could go to Trader's Way if you want to combine these two. Go to Trader's Way, open up a demo account, download MT4 or MT5, and then run the FX Bootcamp installer, and your charts will look like my charts. Killer, right? We have something like Discord, but it's built into the FX Bootcamp platform. The question is, do we have a Discord? We have something like it. We also have software a lot like Zoom built directly into the platform. It's pretty sophisticated, actually, FX Bootcamp. But anywho, so thank you for being here, everybody. Let's get on with the shoe. Let's get back to this in a second. We can take a look at QuantBox just quickly. Just to show you, the biggest winner right now is Swiss franc yen. Because it's way to the right and way up, what this is telling you is QuantBox predicted this a long time ago. All of these things. Let me get my drawing tool. Okay. Everything in this area here, QuantBox has expected it to go up, and it has gone up, and so that's a positive. And everything over here has been predicted based on macroeconomics to be bearish, and it is bearish, and that's how bearish it is. But it's basically everything up here is up in the strong buy, and everything down here is a strong sell, and everything else is the outliers, which are probably the trades you're going to do later today or tomorrow, because they're outliers. Okay, this one is way down, and QuantBox thought up, so that's a big loser. Okay, but you're probably not on that anyways. So anywho, look at that. Like some of these like big winners. Like if you look at, let's pick on this one. You see this, the Japanese stock market. Look how heavily long institutional investors are. 81% of institutional investors are long the Japanese stock market, including Warren Buffett, as you probably read yesterday. But anyways, boom! They're making money today. The institutional investors are high-fiving each other. What's up, dog? Love the Lambo. Yeah. But anyways, what we want to do is look at this. This is current. So gold is the biggest winner. USD Swiss francs the biggest loser. Okay. Oil pausing out. Oil had a great day yesterday, huh? Oh my God. Yeah. But look at this. Is there any congruency? And we see, like, for example, Swissy yen up, Aussie yen up, Kiwi yen up, CAD yen up, Euro yen up, Pound yen up, Japanese stock market up, USD yen up. But notice USD yen is hardly up at all. Why? US dollar is also weak. Yen is weak, so they cancel each other out, and that's why I don't typically trade them. What do you think about that? Well, a couple of things you can learn. There seems to be a correlation between the Japanese stock market and the value of the yen, and you could conclude if the Japanese stock market is up, yen is down. Why is that? It's a risk-on play. Risk-on means get your money out of Japan. Yep. So anyways. Anywho. Okay. Now, why South African Rand so unbelievably bearish? And this is why I have this up. I want you to know that one of the most important things going on right now is the IMF meetings in Washington, D.C. I don't know if you're tracking these things. Oh, can you join FX Bootcamp and join the meeting today? Of course. We have very, very high standards, though. You have to have a minimum of $88 on a credit card. Wayne, my country doesn't have credit cards. We're also blacklisted by the global community, and I was wondering if I can send you Dogecoin to pay for bootcamp every single month. No. Okay. If you're planning to hedge, Family Time says, if you're planning to hedge on SPXU, Yeah. Which one right now, better choice? Well, if you're hedging it, wouldn't it just... I guess I'm not sure what you're asking me. If you want to hedge, you just sell. Or in this case, buy, like SPXU, you just buy it. And that would obviously hedge the S&P 500. So I'm not sure what you're asking me. See, like you're like market trend. Well, they're both. Macroeconomics wouldn't really separate SPX versus QQQ. Down is down. You're not going to see usually a situation where the S&P 500 is up 5% for the month and Nasdaq's down 5% for the month. You're not going to see that. They're both going to be down to different degrees or up to different degrees. Now, if you're going to say to which degree there would be a down, which you'd want to hedge, which I think is what you're saying, my belief is QQQ is more susceptible to higher interest rates. It's also got a higher volatility, right? It's got a higher beta. So I would hedge the QQQ, maybe. Or why don't you hedge your hedge and hedge them both? Yeah. I'm moving my money into a different strategy, and just instead of being triple leveraged short, I'm basically starting a hedged, think of the word, not a hedge fund, a hedged fund. Because most hedge funds don't hedge. I actually want to start a hedged fund that is hedged because it's designed to earn income. Bumpy wants to know if QuantBox says buy, should you just close your eyes and buy it? What do you guys think? Okay, while you answer that, I want to get to this. I'm getting sidetracked by your questions, which are great. I just want to keep on my agenda here. This came out this morning or last night? I can't remember. Okay, so when you look at advanced economies like the United States, very, very, very slow growth. Remember, in the United States, the average over the last 50 years is 2.2. So below average growth. Okay. So let's talk about that briefly. How should I do this? Let's do it this way. I'm going to erase this. Oops. I know, hang on. All right, pretty close, right? All right, pretty close. Okay, so, okay, there's the potential GDP looks like this. And it's growing at 2.2% a year. And then you have something called actual GDP, actual growth. Okay. And it looks like this kind of stuff, right? And all it means is next year, the IMF believes we're going to be below, which is kind of a recession. It's not technically a recession, but you're growing more slowly than you should be. Okay? Oh, Raymond's wants to know if we meet in the second week of August, where would we meet? I believe it'd be New York City at the Harvard Club. But yeah, I guess I got to be careful. If we're gonna do it, we can do it. Yeah, we all need to plan it, right? But I was thinking not like a formal training event, but maybe we could do something like that. I was just thinking of a meetup. Flying across from the bottom of the planet to the top of the planet for cocktails is really something. Miami, I say for the winter, Maida. Oh, is that right? Okay, so if you're in town anyways, yeah, a quick flight, yeah. Jim says, or you were also talking about Tennessee, and that was for like an annual conference, yeah. And I'm also still talking to the cruise line, so I got to be careful. There's just so much. There's so much to do. Anyways, going back to this chart, what this is showing is the United States, for example, according to the IMF, is expected to grow, but below potential GDP. Made us like, yeah, let's just get together. And that's kind of the thing. Like with New York City, dude, you got to see the Harvard Club. Holy crapola! And then dinners and cocktails and cigars, right? But yeah, so all that kind of stuff. Yeah, so we got to do the get-togethers for sure, and those are easier to plan. Okay, so below potential growth is what the IMF is saying. And one thing that you could then consider is that growth in emerging markets are supposed to be higher, according to the IMF. Now, if you took the macroeconomic course, you understand why this is happening. There's different types of growth, and I explain that in the course. But growth is growth. And so you might say, in a risk-on environment where growth is expected to be higher in emerging markets, you invest into the emerging market. And so Rand dropped by over 1% today. Gold is only up less than 1%. So like Rand has dropped almost double gold, and gold is the best up. Yes, Ashish, that's exactly correct. Catch-up growth. Okay, so the biggest loser is twice as big as the biggest winner. And if you're wondering, like, what the heck just happened, it probably has something to do with this. Institutional investors are listening to the IMF. Remember, there's a huge meeting going on in Washington, D.C. right now. And maybe this is more important than PPI, which is coming out in 10 minutes. Now, why would somebody care about this more than PPI? Well, PPI describes the producer price inflation last month. IMF is predicting next year. Where's the money? What data did they use for the projections? Well, the IMF has a unique math. They actually include a little bit of fuzzy logic. And these numbers have actually stirred the bee's nest. Is that how do you say it? Because many countries like the UK, the United States, okay, or two for sure, they see these numbers. And now, by the way, the reason you read the World Economic Outlook is they actually go and they'll tell you how fast they expect the US to grow, how fast the UK is going to grow. Okay? But I'm just breaking this down into, right, OECD countries. And guess what? Canada and the UK are like, oh my God, that's way low. It's sort of getting a negative report card, but in this case, you have to imagine these economies, like, right? Like in the United States, you have Jay Powell, you have Janet Yellen, JL. They're doing their best on either side of their, political institutions to improve the U.S. economy. And so they might be thinking GDP is going to be 3%. And IMF goes, nah, it's only going to be 1.3. And they're like, what? No, it's going to be way more. But of course, if you ask the country itself, hey, United States, you have all these new policies in place. How fast is your economy going to grow? And they're going to say, oh, well, all these things are going to work because it's their plan. And they're like, yeah, we're going to have 3% growth. It's going to be great. And then you have an outside institution like IMF goes in there and says, no, there's no way you're going to get 3. You might get 1.5, maybe. And so there's a big disagreement with these numbers. But you can see, of course, if the IMF said the UK is only going to grow 1%, but the people in charge of the UK economy say it's going to grow 2%, then, there's a way off scenario. Okay? So which one do you use? You use both, Bumpy. You make a decision. That's the answer. You make the decision. Okay? 1.6. Look at the UK. So I kind of showed you this yesterday using QuantBox. Why is the pound so weak? Look at this. The IMF says negative growth. Bumpy says, which data? They just use the data. Data's data. What models do you employ on the data? But of course, data, they're looking at all kinds of pieces of data, but now both could be right. Well, both are right. You have to understand, this doesn't necessarily predict the future. A model takes the variables and manipulates the variables in such a way that the model is designed. Yeah. But remember, all models are wrong. So which one do you use? You use them all, and then you use your brain to make an opinion. Okay? So there's a famous quote, all models are wrong, but sometimes they're useful. So, Bumpy, the model is wrong. The model doesn't describe the real world. It helps you organize your thoughts. Okay? And yes, the projections do change all the time because new variables are added and variables are updated. So just imagine it's a way to more clearly see, based on a set of assumptions, where the variables are pointing. So just think of a model in this case. Let's say there's 100 pieces of macroeconomic data. Like, I guess, let me do it this way. Okay? So, for example, let me pull up a dollar pair here. I'll just pull up, I'll pull up this one. Okay? This is a model. Oh, that's interesting. What is this? Really? Hang on. Never seen that one pop up before. It's annoying. Let me just reload the database. Huh. All right. Well, I'll go bug the... oh. Cannot connect to your data. Oh. All right. So anyways, it's having trouble displaying some of this stuff. There's a glitch in the database. Is it all of them or is it just that one pair? No, it's all of them. All right. So anyways, so that'll be fixed. What I'm trying to say is this algorithm taps into GDP growth, inflation, unemployment, interest rates, retail sentiment, institutional sentiment, technical analysis, levels of interest rates, not just inflation, levels of employment, okay, and seasonality. And it's pulling this data from multiple sources, private and governmental, from all around the world, and then it's scoring and ranking them comparatively to each other, so the Australian economy versus the US economy, with a basket of assumptions. Is it good or is it bad? Well, what the hell does good and bad mean? So, for example, this is correct. It's infallible. It will gather this data and it will compare the two, but based on the rules that the algorithm has been given, and then it spits out the right colors, it spits out the right determinations, and but only based on the model. But it will always do it correctly because it's a machine. It will never sleep in, it'll never make a typo, all that kind of stuff. Okay? And the IMF is doing the same thing. They just have their own algorithm and their own, remember, the algorithm is only a set of rules that humans have given it. And so their sets of rules have looked at the exact same data. I'm sure they look at maybe additional data, but maybe not. QuantBox is pretty smart. But let's say they have 300 PhDs going through all kinds of models. Okay. But at the end of the day, it spits it out and it says growth in the United States will be 1.6. And then the United States comes out and they're like, well, our models say 2.2 or 2.3 because, they want to be above average. And IMF is below average. But which one's right? Well, they're both correct because those numbers are based on the assumptions. Not the data isn't wrong. The assumptions are different. And therefore, right? But does the United States know exactly what GDP is going to be in 2024? No. Does the IMF know? No. Does the World Bank know? No. Okay? So they're just interesting. And you look at it and you're like, okay, that's good. But it might explain why if the IMF basically upgrades exotic currencies, it explains why money might be moving there. And an amateur trader has no idea what just happened. They don't know what just happened and they don't know why it's happening. And I would argue, well, that is an updated model released by the International Monetary Fund, and they said this would occur. And I showed you the chart, and based on that, institutional investors are taking it down. because the IMF is kind of saying slow down, but no real recession. And you want to put your money towards real growth. Think about it that way. Real growth. So Bumpy said, so the question is, who uses the model? Okay, who uses the model? These guys. Andre says, what do you think using Python for algorithmic trading to build a fund? I don't know what other language you would use, so I'm not sure what you're asking me. My assumption is, of course, you'd use Python. But I did the algorithmic trading program at Oxford, the University of Oxford in England. And so I looked at multiple funds. And yeah, Python, yeah. But it's truly amazing what some of these funds were doing that we looked at Oxford was really far out there crazy math. Okay, I'm a Harvard boy, but I was really impressed with Oxford. Right? I mean, what? I did 5 years at Harvard. So I do my little stint, my postgraduate work at Oxford, and holy crap, I was really impressed. And so that algorithmic trading program, looking at what some of these funds were doing, was really, really spectacular. And many of the mathematicians that were working in our program were astrophysicists and such. And so they don't look at the market like we are looking at USD Mexican peso and USD Rand now. And we're looking at price and time, and we're trying to use things like moving averages to do sort of like a lagging measurement of trend. And then we're trying to use some predictive measures like, you know, look at the high of the range, the low of the range, and the sentiment of the range, and try to project the next range. Like it's like silly amateur hour, right? And then these guys, what they're doing, I can't even describe, but I remember staring at some of these models for long periods, and they're not looking at price and time at all. They're not looking at charts at all. They're not like, well, if the 2155 is below, right? If the 21 is below the 55, then look to sell the next stochastic cross. Like, they're not doing stuff like that. They're looking at immense amounts of data and sort of like these predictive. I don't even want to attempt to describe it, but it's truly amazing stuff. Truly, like, they're looking at it truly as a massive data set. They don't even know what they're looking at, but the algo and the AI is looking for the patterns in what I'd almost call noise. Okay? No, way beyond that, Richard. Way beyond that. That's all. You're doing the same thing. Okay, a standard deviation and correlations. I mean, no. It's not what they're looking at. Again, that's amateur hour. Like, that's the kind of crap we do. Like, look I'm doing this on Rand. Okay. Yeah, that's not what they're looking at. You know the opening scene of Inglourious Bastards? It's so frightening. But he's like the Nazi officer, the Nazi SS officer. He's like, naturally, Nazis looking for Jews are going to think like a hawk, right? And the hawk is going to look in the attic and look in the barn, trying to find Jews that are hiding from the Nazis, right? And he's like, but you have to understand that's not the right way of looking at it, right? And the same thing, like the only way we're going to be able to look at what we do is how and the way we think. And just imagine there are fund managers that are on the quant side. I don't even know if I want to call it quant. More algo, more really on the mathy side. They're looking at the data sets, the time series data sets of these currencies, and they're not looking at it at all like what we do. At all. I wish I had some of the charts. I'll see if I can get back into the course and see if I can get, but just imagine that there's a completely different set. Like if I showed you what you looked at, it would just look like modern art. Okay. It's not doing what we do at all in the slightest and stuff. So it was really fascinating to do the course. Anywho. Yeah. So anyways, this might lead us to new lower lows. I don't do order flow. Okay. Is it possible an MT4? I don't think you would use MT4 for order flow. I know Darko experimented with that for a while. That's not something that I do. Using price ladders and stuff like that. You can get it, but it's probably not a good enough version. But if you want to see it, I can go to here. Okay, let me open this up. There we go. You see it? This is a tool for Traders Way clients. How do I become a client of Traders Way? Go to tradersway.com. Anyways, this is a tool for Traders Way clients, and it shows you the orders right there in real time for USD Mexican peso. Okay. Now, not a lot of volume going through on one of these pairs because they're exotic, so there's not a lot of volume. But if you go over, like if we do like a dollar pair, there's going to be crazy volume, right? And oh, look at that. We hit our first target. This is just what we did a week ago, by the way. A week ago, we've planned this trade in the swing trading group. Anyway, so let's look at the volume going through. Look at the orders. 275. Wow, some of those are big orders, huh? See how much faster it's... Okay. Okay. But as far as how do you use it, you're on your own on that one. Okay. But Trader's Way offers that, which is cool. All right, so let's just see where we're going. So we do have a new lower low now. Sam, you said glitches and stuff. Well, with larger, well, that would be a liquidity partner, huh? Wouldn't be the broker per se. It'd be the LP. Luis is long. CPI better than expected. What do you mean by better, Luis? What part did you look at? Did you look at headline year over year? Did you look at headline month over month? Did you look at core or did you look at super core? But honestly, I don't understand what you mean. Like CPI is better than expected, but it's meaningless. Both what? Headline. There's headline year over year, headline month over month. There's core year over year, core month over month, and then there's super core. And yeah. But I suppose you're saying 5 is better than 5.2? Yeah. Yeah. I mean, I'm not disagreeing. I suppose what I'm saying is 3 weeks ago, I did a quarterly outlook that predicted that. Okay, month over month is fine. Okay, good. Remember, though, the Fed's using their new measure of supercore. But nonetheless, much of what we see, like this move right here, you could say this big move is yesterday's CPI, and you could then say, better than expected. Again, whatever better means. But there's another statement that I can make, which is also true. This was supposed to happen. If I could do a quarterly outlook and I go through a whole bunch of research, but most importantly, I just look at seasonality. I could also argue, I'm not saying I'm making this argument, but it's an argument that is, certainly somewhat true, that I think I did the presentation around this point. And what seasonality tells me is, having analyzed 20 years of trading data, this is going to fall. That's what I said 3 weeks ago. So the question is it falling because it's supposed to? Or is it falling because of CPI? Or is it falling because of a change in Fed sentiment? Or is it falling for some other reason? Or is it just simply falling because that's what it's supposed to do? Like, I could have been one of those traders that never even paid attention to CPI. I'm like, I don't care. It's noise for amateurs. I could make that argument. Again, I'm not saying I am making that argument, but I could say that's just fodder for all the dumb traders that are all like, well, what about PPI? What about CPI? What about BCE? What about University of Michigan sentiment? Like, who cares? Okay. And the interesting thing is, well, in this particular case, it was correct. Maybe it's luck, but it's interesting that it's doing what it's supposed to do, irregardless of what's happening. And what this could mean is, again, I could make this argument. I could write a paper saying there is an underlying force that you can't see. Okay? Has anyone read Adam Smith? One of the things he talks about is the invisible hand. Okay? Imagine there's an invisible hand, and we'll just say on this USD CAD, that this time of year pushes this down. And that's that. And then you can add all these other variables that either slow this downward process or speed up. Jim, I don't think he says it in The Wealth of Nations, but I think he says it in one of his other books. I don't remember. I should remember, but whatever. But just imagine, like, the current reality is that we have central banks around the world changing their policy from jacking up interest rates to slowing that process. Canada has already paused, all that kind of stuff. The United States is going to pause. Nobody knows what the Bank of England's going to do, right? But imagine, like, all those, again, I'll back up here. You might recall a few days ago, I discussed with you guys in economics that there's long run and short run economics, right? And long run, you can change variables, and short run, you can't change variables. But what if we change this? Like, let's say on the long run, the variables don't matter at all. And on the short run, the variables matter a lot. And the variables now are current macroeconomic conditions that lead to changing central bank policies. On the short run, meaning this year. But on the long run, there's this idea that there's something that typically happens every year over the last 20 to 30 years. Let's say over the last 20 years, this almost always falls. So you could say, well, you could go into this period where, this almost always falls, so you're a seller. And then on the short run, the current variables either speed this process up or slow the process down. But if it normally happens, then there's a real world rationale for it happening. For example, if you look at the oil industry, there's a buildup of, right? There's a drawdown. Well, it's hard because they're both happening at the same time, but there's a buildup of inventory of oil that leads to an increase of refining because of future demand in the summer. And I'm talking about the United States. Okay? And so if June and July and August, Americans drive around America, they need gasoline. So the gasoline needs to be created. It's a product that's created from raw crude oil. So that has to be made before the summer, which means the refiners have to buy oil now so that in June there's gasoline at the pump when Americans drive to grandma's house, or they drive to the beach, or they drive to the mountains. Okay? So if you need gas in June, okay, then oil needs to be refined into gasoline in May, which means you need to place the orders now for raw crude oil in April. And maybe that normal process is, remember, it's human behavior. I don't know if any of this is true, but let's say it is. Then this is going to happen next year too. because it's human behavior. That's not magic. It's logic. And if that tends to always happen, then you might have a situation where that always benefits Canada. But what about the central bank? What about CPI? What about PCI? What about PCE? What about the University Consumer Confidence Survey and all that kind of stuff? Yeah. Those are short-run variables that either speed this up if it's congruent or slows it down if it's dissonant. Okay? And one of the points I was making yesterday is many amateur traders are trading CPI here. They're not trading it here, and they're certainly not trading it here. And I want you to understand that there are two forces going on, and I want you to understand both. So my book, I break it down the exact same way. And remember, I wrote the book 15 years ago, 10 years ago, 12 years ago. I don't know when I wrote the book. When did I write it? 2008? 2007? I don't remember. I think maybe it was published 2007, which means I wrote it in 2006. Oh my God. Anyway, so this is strategic. And this is tactical. And many fund managers are not tactical at all. They're not tactical at all. They're not down here. They're up here. And they're going to hold it for a long time. So I don't think that's right either. But there are many institutional investors that are only tactical. And right, let's say the majority of institutional investors are purely strategic. And the majority of retail traders are purely tactical. Meaning long, or short, long, long, 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 short, long, short, long. And somebody over here just sold it and said, I'll come back in 3 to 6 months. Published, thank you. Published 2008, so I wrote it 2007. Okay. Yeah. Cool. Cool, right? So again, I'm imploring you to challenge what you do for the potential to improve. You can't just keep doing the same thing over and over and over again and expect a new and improved result. So anywho, let's go to the commodities and then we'll call it a day. Okay. My WTI. Okay, we're not to my target yet. Cool, right? Cool beans. Next level is 87. Oh. Do you remember doing this? I did this almost 2 weeks ago. All I did is, remember, we had gapped. Remember that giant gap? I was in Italy at the time, but OPEC cut production right at a point where demand is about to show up. You understand? So that pushes up prices. They did it perfectly timed, right? So when I got back, all I said is we probably want to buy the dip or fill the gap. The first opportunity is buy the dip. The second opportunity is buy the gap, right? But we never got there, so that's irrelevant. So the first one is buy the dip. So it came back and it made a 382. Simple enough. I'm just measuring the gap. So it came back, did a 382. If it kicks off that, then we should be going up to 87. Sweet. That's it. Neato. Is today risk on or risk off? Well, let's take a look. Let me not give you an opinion. Dollar's down, yen is down, risk on. Yeah, Andre, if you never pay yourself for 26 years, yeah. Yeah. So one of my goals is, can I build a fund that vests into the stock market that can produce 10% a year every year? That's my pet project right now. And my thought is, you cannot predict with any real accuracy the price of a stock. Okay? So that would be a fool's errand. But you can predict the income that it produces. And you can enhance that income through various strategies. It's not precisely predictable, but it is predictable, the income side of it. So the thought here is, you buy an apartment building. Okay? Here's the apartment building. And you pay $1 million for this building, right? So I'll put some windows here. And then I guess it needs a door. All right, cool. It's a nice building. Okay, cool. All right, cool. So you pay $1 million for this. Why is it worth $1 million? It actually has to do with the rent. Nothing else. Okay? In fact, it's rent minus expenses. So it's a form of net operating income. Okay, great. So what is this what is the you paid $1 million for it. What's this value going to be worth in 5 years, 10 years, 15 years, and 20 years? Now, the issue is you actually have to roll your mortgage over every 5 years. So this matters a lot when you're investing in real estate. Not individual houses, right? We're talking about, commercial properties like an apartment building. Retail's a little different, warehousing's a little different, but stick with apartment buildings. It's the best. Okay, cool. But here's the thing. Let's say you pay cash for it. So you're not so sensitive. But do you know precisely what the value of this building is going to be in 5, 10, 15, 20 years? Okay? It might be worth more in 10 years than in 15 years. It's possible that in 10 years it's worth $2 million, and in 15 years from now there's a recession, so it's only worth $8 million, and then 20 years it doubles again to $16 million. But you don't really know. It's a lot of guesswork. You don't know the property values. Maybe your city slows down. Maybe the global economy slows down. Maybe the national economy slows down. Maybe the neighborhood changes and nobody wants to live there. Maybe the neighborhood changes and everybody wants to live there. You don't know with much accuracy what this is going to be worth in 20 years. But you do control rent. And you can have some base, best, and worst case scenarios for rent, but rent is more interesting because it's a monthly income. So if I can't be assured that you can make 10% investing in now, see, like when I say, when I'm talking about the fund I have in my mind that invests into the stock market for people's retirement accounts, you invest the vast majority of your money into an asset. So a real estate fund would invest the vast majority of the money into real estate. Like there's literally a building somewhere. Well, my fund would be a stock fund, and it would hold stock. It would own stocks. Let's say 80% of the money goes to literally owning the stock. Okay, cool. But I don't know what the portfolio of stocks are going to be worth in 5, 10, 15, 20 years. So I can't say, well, it's going to earn 10% a year, but I don't know what it's going to earn this year or next year. It could just be sideways, right? It could be up, it could be down. Like, who the heck knows? Now, of course, you can do some more analysis than that and say, well, I'm looking at the macroeconomy and I think the underlying trend is going to do this. And then I've done a lot of analysis on this corporation. It's got good management. It's investing into research and development. It's got a good core market share. So it's got leadership, and you can make all those things. That's fundamental analysis of a stock. But at the end of the day, like, you can try to mitigate that risk, but I would still argue, because I'm a macro guy, not a micro guy, I would say, well, you still don't know. You can't promise somebody 10% a year if you bet the whole thing on, will the value of the stock go up? I don't know. Maybe, probably, I think. Okay? But if you flip to the other side, what if you only invested into corporations that paid you rent? Like an apartment building. I don't know what the apartment building is going to be worth in 5 and 10 years, but I know what the rent is likely to be. I'm still collecting rent every month. So I can say, well, I don't know what the value of the property is. And if it goes up, I could refi and put some money in our pocket. But it might go down, so we need a rainy day fund. So I don't know about that. But I do know rent minus expenses will make $10,000 a month profit. When you calculate all the rent minus the expenses, you have your net operating income. We paid cash for this, so we don't have debt to service. So at the end of every month, we have $10,000. I don't know about if it's going to be worth 1 million or 2 million or whatever, but I do know every month I'm going to earn 10 grand. So we got 1% a month, which means at the end of the year, you have your 10%. So like, I don't know anything, but as long as I can keep rent stabilized and my expenses as fixed as possible, I can pretty much count on the 1%. Maybe one month it's 0.8%. Maybe the next month is 1.2%. Or over time, I can boost this. Or maybe over time it's slightly less than that. But that's what I would like to design, where you're like, okay, cool. And then, of course, in 15 years, you sell the building for 300% profit. But meanwhile, you're earning your 1%. You see, like that's what I try to get to. You're looking at the market in a completely different way. Okay. And so far, I've been able to do it in my own retirement account. I just have a small portion set aside to, like, can I do this strategy? And I'm collecting the money. Okay. So, like, I suppose, did I kill it? Is it still there, the drawing? Yeah, it's still there. So here's the point, like this might drop from 1 million and then there's a bad economy, so it drops to 800K. Okay. But you're not mark to market, so it's a paper loss. But meanwhile, you still get your 1% a month. And then 5 years later, this changes to 1.2 M. So now you're up, but you don't have the 200,000 in your pocket. It's just paper money. Meanwhile, you still collect your 10% a month, $10,000 a month. Okay. 15 years from now, okay, it's worth 1.75 million. The economy's been booming. Well, you don't have the 750,000. I mean, you have it, it's sitting there, but you're not spending it. It's just sitting there. The value of the building went up, but you haven't sold it, so it's just there. So your net worth went up, but your cash didn't go up. So your net worth goes up. Now your $1 million investment over 15 years is now worth 1.75. But meanwhile, every single month, you still just collect your 10,000. But maybe rents go up over time, so now you're making 12,500 a month. Okay. But there's been some inflation. So you're like, well, that's not real. But whatever, it's still happening. You're trying to get to that 1.2 or that 1% a month, you see? So now, so Peter says, hey, so Ashford Hospitality Trust will pay you the 7.34. So what you do is you need to then construct a portfolio that leads to this. Now, Peter, you wouldn't put all your stock into that, but maybe you include that. But then you have to look at the beta, you have to look at the systemic risk, you have to look at, the inherent risks of that particular stock. Do I want to own a trust? And do I want to be in hospitality? And so you still have to construct a portfolio. And like there's entire classes at Harvard that just on portfolio construction. So you still have to design and construct that portfolio, but you're not going to get enough because you want to lower your risk. That's the other thing is you don't want high beta where this goes up and then down and then up and then down and then up, because it erodes your real returns, right, on your total return. So you want to construct a really smart portfolio. You obviously want it to be income producing because you don't want to flip stocks. I'm not like an apartment building flipper or a house flipper. I want to buy a really good apartment building in a really good city with lots of jobs in a really good neighborhood where everybody wants to live because I want stable rent. I'm not trying to make a lot of money on the apartment building. I'm trying to have stability in my rent because I want cash flow. I'm giving up cash, static cash sitting in a bank for cash flow. Okay? So I need to construct a stock portfolio that, yeah, produces income. But even then, you're not going to get enough. Okay? So you build a balanced portfolio. So I would want to own hundreds of stocks so that the individual stocks offset each other risk-wise. So now you have let's say, almost a market neutral portfolio of dividend stocks. So now you do have income, but you might only get to like, of your 1% a month you're trying to get, let's say you only get halfway there. You only get a 0.5% a month on income. And also it's only producing that income quarterly. And I want to do it monthly. So then you got to employ additional strategies on top of that. And that's why you'd only have 80% of your money into the asset. And then the other 20% is used to enhance the income so that you can get your 1%. So, look, it's not child's play to get this as low risk as possible. But the way to look at it is what you're really doing, and this is what I like about it, if you construct this portfolio correctly and you enhance the income correctly, the income enhancement is the hedge. You're hedging this. And most non-accredited investors, most average people, don't have anything like that in their portfolio. Most people don't have anything like that. They have their stocks in a bunch of mutual funds, and that's that. Why? I mean, how many companies in America say, welcome to our company. We have a comprehensive retirement program for you. And then you get there and they're like, you have 3 choices. Choose retirement package A, retirement package B, retirement package C. And you're like, what's in this stuff? Don't ask questions. Nobody knows what's in these things. You just have to pick one. Don't ask so many questions. Just pick one. B? Okay, you're in B now for the rest of your life. Most people have no idea what's in the retirement package. Okay? So anyways, they're certainly not hedged either. So they're told that the retirement account only invests into mutual funds in large cap companies because they're risk averse. Is that true? Well, what happens to the mutual fund when the stock market falls? The mutual fund loses money. What does it do to hedge that? It's not allowed to hedge. So why is it safe? They're only big companies? Like, what? Why are they safe again? Because they're only big companies? Okay, what companies are you investing my money in for the next 25 years? Oh, we can't tell you that. So I would say the vast majority of Americans have spent less than 5 minutes thinking about or even understanding what their money's retirement account's going to do for the next 30 years. They just pick A, B, or C. I guess B. Boom. That's what you do. Yeah, and to me it's scary. So once again, I guess I'm in this period of my life, like I need to figure out what I want to do with the next 25 years of my life. And what contribution can I give humanity? In my 20s, I worked in a nonprofit world and I gave back to society. And then in my 30s and 40s, I've run FX Bootcamp, which was my way to get into heaven by saving your Forex soul. So I've spent now another 20 years giving back. That's how I look at it. And now what do I want to do with the next 25 years? I'm perfectly happy with what we've been doing. I love our time together every day. Like, I'm looking forward to the swing trading group this afternoon. It's like an amazing time. So like, I'm not going to change any of that. But then, you get to this point in your life, they're like, I had children, I'm raising children, and now they're going to leave soon. So you have these periods of your life. And so like, I'm transitioning now into another, my kids are going to be gone. I'm going to have more time, all that kind of stuff. What do I want to do with the rest of my life? Do I want to retire early and travel through Italy? Look, Italy was nice. I don't want to do it again. So what am I going to do with my next 25 years? I'm like, well, I want to continue contributing to society. And there's two things I love. You and money. Right? So how can I contribute to society? I want to take care of people's money, their retirement. I want their money to last in perpetuity. Do you know how most people become wealthy in America? They were given money by their relatives. So my guess is if you ain't got no money, I bet you your daddy didn't have any money. I bet you your grandpappy didn't have no money. And your grandpappy's grandpappy ain't got no money. So how are we going to break that process? When you die, you got money and it's going to your lineage, and you break that cycle. Okay? So if you don't go to Harvard, your kids go to Harvard. If your kids don't go to Harvard, your grandkids go to Harvard. But you break it, right? Yeah, breaking the cycle. So in your last dying breath, you lean forward and your great-grandchildren are all gathered around your hospital bed. And your last words are, please be sure to thank Wayne for breaking our negative cycle and providing a lineage of success. Yeah, that's what I want. It's carved on your tombstone. Thank you, Wayne. Yeah, last words. Sell the dollar. Buy gold. So anywho. So yeah, somebody asked, is this risk on or risk off? Well, it looks like risk on to me, but All right. Take a look at some metals. I sure enjoyed selling metals. And palladium. Oh, do you remember that palladium trade I made? Monster trade. But you only get paid on the downside. And I haven't sold palladium now in a couple of months. But this downward move was monster. And look at the consolidation we're in, huh? So it's not up yet. Now look at the swing trade, M2, M4, and that would change things. But this is suggesting right now, it's not predicting, it's suggesting that if we stay consolidated like this, it's like the risk on that we have might only last 3, 4, 5, 6 weeks, and then come back around, right? So that the risk tomorrow is banks show a sign of, like for example, why did I skip PPI today? I don't even know what the PPI number was. It came out almost an hour ago. I don't care. So the market, what the market cares about and what the Fed cares about is credit standards. So I don't know if you're getting this from anybody else, but this is the thing that now matters. So like, you know, whoever said it before, like, oh, well, you know, CPI was better than expected and that's why I'm doing this. I'm like, okay, like that's not wrong. You know, like, yeah, okay, I got you. But the interesting thing is that would be sort of a normal response in a normal world. But that's not the question at play for those that move the market. For regular old people, that might be fine. Oh, CPI, good, bad. And again, I don't know what good or bad means because we're asking, does a falling CPI force the Fed to, let's say, raise interest rates further than that's priced in? Does it force them to pause sooner than expected? Does it force them to pause later than expected? Does it force them to cut or not cut later in the year or defer that to next year? Like, what do you mean by good or bad? You're like, well, better than expected, but that could be bad. Like it's a weird thing because, you know, what we care about is behavioral. We don't care about higher than expected or lower than expected. We care about how it influences market participants, investment strategies, and in particular, all related around monetary policy. And now, so the question is, well, then what impacts the monetary policy? Is it the CPI or stuff? I'm like, well, we already kind of knew all of that. We're already in that trend. So what did Jay Powell tell us about at the last Fed press conference? And he said, and I highlighted this in my quarterly outlook, I hope you paid the $11. But I showed very specifically, I have a slide and a video that highlight that he says, this is the most important thing. In fact, this does the work of the Fed. And if this is doing a certain thing, then they don't have to do another thing. Okay? This could replace monetary policy. And our first look at that is tomorrow. You see? And I find most market participants aren't even asking the right questions. And it's a problem. In particular on the retail side, because look, people don't know. Okay? But this is the thing that you should be focused on. And that institutional investors are doing this. And they're actually looking at Fed reports and all that kind of stuff that banks have to file at the Fed. And all these things at a much different level than PPI. So if there's some other YouTube guru, you know, freaking out on PPI and go, sell, scalp. It's a chuckle, actually. Whatever, cool. Well, good for them. But this is what matters. This is what matters to large institutional banks and hedge funds and endowments and pension funds and, you know, all that kind of stuff. Okay? This could replace monetary policy. Do you think that matters? You're like, dude, it's the only thing that matters. Well, I know that, and now you know that. And this is my contribution to society. Like I said, I'm trying to buy my way into heaven by saving your Forex soul. And I said that 15 and 20 years ago. Okay. Neat, right? So anyways, so I can watch Palladium, see if it helps. But this is what matters. And our first look is tomorrow during earnings season. So Monday could be interesting, and it could be a day that reverses things. Burned, I showed, I did research using the Fed's database, and I did the research, produced a chart, and shared it during the quarterly outlook. So I went through this and I explained what credit standards are. I showed when Jay Powell actually said that that's the thing they care about and that it could replace monetary policy. So I showed all that. I showed the video and everything. And then the next slide says, so are credit standards tightening or are they staying loose? And then I showed the research I did to show reality of what is actually happening. And then I took that and I threaded that into how the markets would react. Isn't that neat? So I hope it was worth $11. I said at the end, I said, I hope it was worth at least $13 or $14 in value. But right? Instead of charging $11, I guess I could start a mastermind group that charges $10,000 a year and I can do this for you. But I thought, why don't I just charge $11? Yeah. 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 By the way, would anyone be interested if I started an affiliate program for QuantBox? I've never done an affiliate program, and it scares the bejesus out of me that some person goes on to some blog and says, QuantBox is going to make you $1 million a year. You should just buy it here. Click this link. That scares the crap out of me. But I might be willing to give it a try once I make some changes to QuantBox. One of the things I want to change, and I think by July, I'm going to launch a new iteration. So many of you have just signed up for a year of QuantBox, and I'm taking all that money and I'm reinvesting it in, I'm going to release some new features. So for everyone that already signed up, they're going to get even more with the money they invested. So I'm already taking out of that. And so I think in that release, one of the things I want to do is get rid of the strong buy, strong sell. I really don't like how the developers did that. So in the next one, it'll be like bullish or bearish, that kind of stuff. But then some new features. So once I get that, because I don't like the buy and sell. So something could be incredibly bullish or incredibly bearish, and that's that. So I think if I do that and release these new features, I think one of the things I can invest the money in to, besides this new feature I want to design, I want to design and integrate an affiliate program. So would anybody be interested in something like that, where you promote QuantBox and you get a little something for your troubles? But But the idea is I want you to be proud, like a proud representative. Is that right, Bernd? Right? Like a proud representative of this amazing tool, and be able to communicate similar messages. Like if you went through the hour-and-a-half presentation I gave, that's the kind of like thought and logic I want in there, where I never really talk about QuantBox at all. I talk about the importance of it, right? So anyways, I've taken too much of your time today. I apologize. Market just opened. We got to go. Wake up. You got to make the money. Right? What's that song? It's now in my head. With my muscle, but now I'm stressed out. How does that go? Yeah. So anywho, yeah, I will see you tomorrow to do the bank earnings come out throughout the day tomorrow. If you're in my day trading group or if you're in my swing trading group, I will see you at 4 for the greatest 2 or 3 hours. Usually it's 3 or 4 hours. 2.5 hours of the week. It's that swing trading group. How do you become a member of the swing trading group, you ask? You go to FX Bootcamp and you pay $88 and you become a member. That gives you 88 hours of training videos, and it gives you access to our Discord-like community. Okay, great. But then you're like, this is the most amazing thing. I want to join the swing trading group. Okay, great. There's a thing on your dashboard that says upgrade to the swing trading group. And it's $99 a month, and it unlocks access to that community. Sweet. Is it recorded? Yes, it's recorded. But much of what we do, not always, but often, we do group work. And that's not recorded. So I highly recommend you show up if you can. Have a webcam, dude. And don't say, I don't have a webcam. Dude, what is it, $12 to buy a webcam? Buy a webcam. Okay? And then what? Be part of our community. And I think you really like it. So, anywho, peace on earth. May the pips be with you. May your profits be above average. That just happened.